Good evening. This is your financial news update. We begin tonight with a significant development in the global commodities market, where silver has experienced one of the most extreme short-term declines in its recorded trading history. Over the past 15 days, the scale and speed of the sell-off have placed it among only a handful of comparable events, drawing attention across financial markets and prompting renewed examination of historical patterns. According to the available data, there are only two other instances in modern history where silver has recorded a similar magnitude of decline within such a compressed time frame. Those events occurred in 1980 and again in 2020. These two historical comparisons are notable not only for their rarity, but also for the distinctly different outcomes that followed each event. In 1980, the decline marked the peak of a major price surge, which was followed by a prolonged downturn lasting approximately 2 decades. During that period, silver prices fell from around $50 to below $5, representing a decline of roughly 90%. In contrast, the 2020 event occurred during the early phase of a broader market disruption linked to the COVID-19 pandemic. That decline was followed by a sustained rally, with silver prices rising from approximately $12 to $121 over the following years, representing a tenfold increase. As of the most recent market close referenced in the report, gold ended the week below $4,500, while silver closed below $68. These price levels come after a period of sharp downward movement, adding to the volatility observed across precious metals markets. The current situation has led market participants to compare present conditions with the two historical precedents, raising questions about whether the recent decline represents the conclusion of a broader upward trend or the beginning of a new phase. The data indicates that the recent sell-off is not consistent with typical market corrections. Over approximately 15 trading days, silver prices declined from around $80 to below $68, representing a drop of more than 15% within 2 weeks. This movement followed an earlier decline from $121 to $80, bringing the total decrease from January highs to over 40% in less than 2 months. The speed and scale of this cumulative decline are key factors in its classification as a statistical outlier. Such movements are rarely observed and are typically associated with periods of significant market stress or transition. The comparison to the events of 1980 and 2020 underscores the unusual nature of the current price action. Looking more closely at those historical benchmarks, each provides a distinct context. The 1980 event followed a period of intense speculative activity, including concentrated buying that contributed to rapid price increases. When that activity ended, prices declined sharply and continued to fall over an extended period. In contrast, the 2020 decline occurred during a broader liquidity event where market participants sold assets across the board amid uncertainty. That sell-off was followed by a strong recovery and sustained growth in silver prices. The current market environment is now being examined through these historical lenses, with attention focused on identifying similarities and differences in underlying conditions. One of the primary areas of analysis is supply dynamics. In 1980, available supply was not constrained, and the price increase was largely driven by speculative demand. When that demand subsided, prices adjusted downward due to the absence of fundamental support. In contrast, the current environment is described as one where supply growth has been limited over an extended period. Silver production has remained relatively stable, with no significant increase in output. Investment in new mining projects has been low, and the timeline required to bring new production online is measured in years rather than months. These factors contribute to a supply base that may not be able to expand quickly in response to rising demand. At the same time, demand for silver is linked to multiple sectors. The report references uses in solar energy, electric vehicles, data infrastructure, telecommunications, medical technology, military applications, and nuclear energy systems. These applications represent ongoing industrial demand rather than short-term speculative interest. The combination of stable supply and expanding demand is presented as a defining characteristic of the current market environment. Another factor highlighted in the report is the cost structure within the mining sector. Silver producers are operating at estimated costs between $12 and $15 per ounce, while market prices remain significantly higher even after the recent decline. This indicates that profit margins remain elevated despite price volatility. However, despite these margins, investment in expanding production capacity has not increased at a pace sufficient to significantly alter supply levels. The report also emphasizes the time required to develop new mining operations. From initial discovery to full production, the process can take between 7 and 10 years. As a result, current supply constraints cannot be resolved quickly, even if investment increases in the near term. This structural limitation is a key component of the broader market analysis. In addition to supply considerations, macroeconomic conditions are also being examined. Historical comparisons again provide context. In 1980, interest rates were raised significantly, reaching levels as high as 20%. These high rates created an alternative for investors, offering returns on cash holdings that reduced the appeal of non-yielding assets, such as precious metals. In the current environment, the report notes that government debt levels are substantially higher. The United States national debt is cited at $38 trillion, with ongoing increases. Interest payments alone exceed $1 trillion annually. These figures are presented as constraints on the ability to significantly raise interest rates, as higher rates would increase the cost of servicing existing debt. Current interest rate levels are described as being within a range of 3.5 to 3.75%, with limited scope for further increases or decreases. The report indicates that inflationary pressures, including those linked to energy prices, are also influencing monetary policy decisions. This creates a situation where traditional mechanisms for controlling inflation, such as aggressive rate hikes, may be less effective or more difficult to implement. The relationship between interest rates and commodity prices is also addressed. Historically, higher interest rates tend to reduce demand by slowing economic activity. When the ability to raise rates is constrained, commodity prices may continue to rise if demand remains strong. This dynamic is presented as part of the broader context in which the silver market is currently operating. The report further connects these trends to developments in energy and agriculture. Rising energy prices can influence production costs across multiple sectors, including food production. Agricultural commodity indices are noted as approaching long-term resistance levels, with some crops showing signs of upward movement. These interconnected trends highlight the broader impact of commodity price shifts on the global economy. As the analysis continues, attention will turn to additional data points, including market indicators within the mining sector and technical levels that are being closely monitored. These factors are expected to provide further insight into the current position of the market and the potential implications of recent price movements. Part 2. Continuing from the broader overview of the recent developments in the silver market, attention now turns to detailed indicators within the mining sector and key technical levels that are being closely monitored as part of the ongoing analysis. The performance of mining stocks has mirrored the volatility seen in the underlying metal, with significant declines recorded over a relatively short period. One of the primary benchmarks used to assess this sector is the Gold Bugs Index, commonly referred to as the HUI. According to the data presented, the index reached a peak near 950 before declining to approximately 683. This represents a drop of more than 28% from its recent highs. The movement of the HUI is particularly important because it reflects investor sentiment toward gold and silver mining companies. These companies are directly tied to the production of precious metals, and their stock prices often respond not only to changes in metal prices, but also to broader market conditions, including liquidity and risk perception. At present, the index is trading below several key technical indicators. It is below the 20-day moving average, which is noted at 822, and also below the 50-day moving average at 847. These levels are commonly used by market participants to assess short-term and medium-term trends. The fact that the index is trading below both averages suggests sustained downward pressure in the near term. The next significant level identified in the report is the 200-day moving average, which is currently positioned at 626. This level is described as a critical support point. In technical analysis, the 200-day moving average is widely regarded as an indicator of long-term trend direction. When prices approach this level, market participants often view it as a potential area where buying interest may emerge. The report highlights that this level represents what is referred to as the last line of defense for the mining sector within the current cycle. If the index stabilizes at or above this level, it may indicate that the recent decline has reached a point of support within the longer-term trend. If it falls below this level, it would represent a deeper shift in market conditions for mining equities. In addition to price levels, momentum indicators are also being monitored. The moving average convergence divergence, or MACD, is cited as being at a reading of negative 33 on the daily chart. This is described as an extreme oversold condition. Such readings are relatively rare and typically occur during periods of intense selling pressure. Oversold conditions are not uncommon during sharp market declines, but the magnitude of the current reading places it outside the range of typical corrections. This reinforces the classification of the recent movement as a significant event rather than a routine fluctuation. A second key index referenced in the report is the XAU Gold and Silver Sector Index. This index provides another measure of the performance of mining companies and is used to assess broader trends within the sector. The XAU is currently reported at a level of 328, having declined from above 450. The significance of the 328 level lies in its historical context. This level corresponds to a previous breakout point from a multi-year base. In technical terms, a breakout occurs when price moves above a resistance level that has held over an extended period. Once that breakout occurs, the former resistance level can become a support level if prices return to it. The current situation, where the XAU has declined back to this level, is described as a retest or throwback. This is a recognized pattern in technical analysis. When a breakout is followed by a return to the breakout level, the reaction at that level can provide confirmation of the trend. If the level holds, it suggests that the breakout remains valid. If it fails, it may indicate that the breakout was not sustained. The report emphasizes that the XAU is now positioned directly at this critical level. As such, the current price action is being closely observed to determine whether support will hold. This moment is described as a key point in assessing the direction of the mining sector. The concept of a throwback is further explained as a process that tests the strength of a prior breakout. When such tests are successful, they can reinforce the underlying trend by confirming that buyers are willing to enter the market at that level. This can provide a foundation for further upward movement. Conversely, if the level does not hold, it may lead to additional downward movement toward lower support levels. In the event that the 328 level does not hold, the report identifies 300 as the next potential support level, followed by levels in the mid-200 range. These levels are noted as possible areas where price stabilization could occur if further declines take place. The analysis also places these technical developments within the broader context of the mining sector's position in global financial markets. According to the data presented, mining stocks currently represent approximately 1% of global equity markets. This figure is significantly lower than historical levels observed during previous commodity cycles. For comparison, during the commodity supercycle of the 1960s and 1970s, mining stocks accounted for approximately 12% of global equity markets. This historical reference is used to illustrate the relative scale of the sector's current market presence. The difference between 1% and 12% is highlighted as a measure of the sector's current positioning relative to its historical role. This comparison provides context for evaluating how the sector is perceived within the broader investment landscape. The report further explains that changes in this relative weighting can occur through a process known as re-rating. Re-rating refers to a shift in how investors value a particular sector, often resulting in increased investment and higher market capitalization. Even a partial return toward historical levels would represent a significant change in the sector's share of global equities. At the same time, the report notes that mining companies are currently operating with strong profit margins. Production costs are estimated at between $12 and $15 per ounce, while market prices remain substantially higher. This creates a situation where companies are generating significant cash flow despite recent declines in share prices. However, despite these conditions, mining stocks have experienced broad selling pressure. This is attributed in the report to factors such as margin calls and broader market liquidation. During periods of market stress, investors may sell assets to meet financial obligations regardless of underlying fundamentals. This can result in price movements that do not directly reflect the financial performance of the companies involved. The interaction between these technical indicators, sector positioning, and broader market conditions forms a key part of the ongoing analysis. The report suggests that the current environment is characterized by a combination of strong underlying fundamentals and short-term market pressures. As these developments continue to unfold, the focus remains on how key levels in the mining sector respond to ongoing market activity. The behavior of indices such as the HUI and XAU, along with their interaction with established technical levels, will provide further insight into the current phase of the market cycle.